Hello, everyone. My name is Adam Crowell. I'm President and General Counsel of ComplyNet, and we're very happy to introduce today the dealership advisors from Brady Ware, who will be providing a stimulus update and potential tax changes as it relates to the PPP loans. Today, we will have with us Sam Agresti, Matt McKinnon, and Brian Denlinger, who are all CPAs with Brady Ware. And to provide you with a brief overview of what we will be covering today, we're going to be talking about PPP Loan 2.0. We're going to provide you with an update on the original PPP loan and the loan forgiveness. We're going to talk about Employers Retention Tax Credit. We'll talk about other tax credits available and potential tax changes, which include individual tax provisions, business tax provisions, and estate tax matters. As we're going through the presentation today, if you have any questions, please leave your comments in the chat section, and we will make sure that we have individuals that will get back to you after this presentation as quickly as possible. So to begin, I'm going to go ahead and turn this over to Brian Denlinger, and he will start off today's presentation. Thank you, Brian.
Appreciate it. Thanks, Adam. Before we get into PPP round 2, I wanted to touch a little bit on the forgiveness PPP round 1. So if you haven't already, the application for forgiveness, that process is open. It's now open to all loans. You know, previously there was a pause for loans under 150, but that is now accessible. So what the process will happen, you'll go through the forgiveness application, and you will start that with the bank. You'll fill out, there's one of 3 forms that you can utilize. For most larger companies, you'll either use form 3508 or 3508S. I'm sorry, 3508EZ. 3508S is going to be used, or 3508, excuse me, is going to be used only when you have either a reduction in FTEs or a reduction in salary for your employees. The 3508EZ, on the other hand, is only for those that are self-employed with no employees, or the borrower had no reduction in FTE or reduction in employees' salary. The other alternative is that if you were physically shut down or limited in your business activities due to the COVID-19 health guidelines in your specific state or in your area, if you couldn't operate normally, you're allowed to use this 3508EZ. The last form is the 3508S, which can only be used by those companies that obtained a loan under 150,000, but it cannot be used if the loans are between an affiliated group exceed that amount. Now for round 2, the application process started on January 11th. For all either first-time borrowers or for people trying to get a second round loan. The deadline for submitting an application is March 31st. Now, this only applies to those borrowers for those that are trying to get a second round loan. You have a couple of options. You can either go back to the same bank that you used in the first time, or you can get a new bank. There's no requirement for you to stick with the same bank. The overall requirements for forgiveness of a round 2 loan are the same as going to be for round 1. You've got required to have at least a 60 to 40% split between payroll and non-payroll costs. You can maintain employee headcount, and again, those headcounts, those FTEs are based on a 40-hour work week, not a 30-hour work week, which is other guidelines. This is based on a 40-hour work week, and then you must maintain an employee salary. If you have a reduction of employee salary more than 25%, that's going to be factored into it, into your forgiveness. However, any reduction of less than 25% does not interfere with your total forgiveness amount. effective yesterday, actually, on Wednesday, the 24th, only businesses with fewer than 20 employees were allowed to apply for round 2 funding. This is going to be a 2-week stay on any businesses with more than 20 employees. This is something that President Biden just signed because he wanted the small businesses to be the ones benefiting for the next 2 weeks. Those larger corporations that have more resources available make it easier for them to get applications, but it doesn't help those smaller businesses. So the basics of round 2, this is open to either a first-time borrower, which follows the same guidelines as the round 1. So it's open to companies with fewer than 500 employees. However, if you're a second-time borrower, it is limited to only those companies with fewer than 300 employees. To qualify, you had to have a reduction in revenue quarter over quarter from 2020 to 2019 that exceeded 25%. So if we look at second quarter of 2020 and our revenues dropped more than 25% as compared to second quarter 2019, then you are eligible for a second round loan. In order to qualify for a second round loan, you must have utilized or willfully utilize the loan amount from round 1. Contrary to the first round, when you had a maximum loan amount of 10 million, the maximum loan amount for round 2 funding is for a second-time borrower is 2 million. The calculation is the same. It's 2.5 times your average monthly payroll. However, this time around, you can use either your 2019 payroll or you can use your 2020 payroll. There's an expanded use of the funds, which we'll go over on the next slide. Expenses with PPP funds are fully deductible for tax. This was signed back on December 27th, or clarified with the stimulus bill. And again, the EIDL grants, if you got the EIDL advance of up to $10,000, that does not reduce your forgiveness amount. That's something that was recently changed as well. So for eligible costs of PPP round 2, it's largely the same as before. We've got payroll costs, which could be wages or commissions, capped at $100,000 per employee. Company paid health insurance, company paid retirement contributions, your state unemployment. And new with round 2, they added group life, disability, vision, and dental insurance benefits as an eligible payroll cost. All of these costs can actually be utilized in determining your loan amount as well. So you may be entitled to a higher loan amount than round 1 if you recalculate your costs. Those non-payroll costs are utilities, which typical gas, water, electric, your rent, mortgage interest on eligible loans, and then they added the expanded uses for PPE, that personal protective equipment. Expenses paid to facilitate remote operations if employees are working from home and you had to provide additional supplies, or if you had some expenses that weren't covered by insurance due to vandalism or anything that happened during 2020 as a result. That's high level PPP round 2. Up next, I'm gonna hand it off to Matt McKinnon. He's gonna talk about the employee retention tax credit.
Thank you, Brian. Good afternoon, everyone. So, one of the big things in the news lately with respect to tax incentives is this ERTC, or Employment Retention Tax Credit. And, let's start, what is it? Well, it's a tax credit that employers will get against employment tax liabilities, okay? Originally, this came out in March of last year as part of the CARES Act. And let's talk about some of the specifics for the first pass of this ERTC information. So it was fully refundable. It's not limited to your tax liability. So there's options there to get excess monies that you perhaps have not paid yet in terms of payroll tax. It's calculated on up to 50% of wages paid to an employee during the respective period. And the first period for the CARES Act, round 1, if you will, or I'm sorry, the ERTC round 1 was March 13th of last year through December 31st of 2020. So we're focused on 2020. So What does that mean? The maximum amount of wages that could be considered for this credit would be $10,000 per employee for that entire time period. So the maximum amount of credit that an employer could receive for a given employee during March 13th through December 31st of 2020 was $5,000. So how do you get this money back? You claim it on your quarterly employment returns in Form 941 by reducing deposits that you'd otherwise be required to make. If there's excess there, meaning the credit calculated exceeds your tax liability, then you can file Form 7200 to receive a advance payment of the excess credit. So again, you can get the money back, refundable credit, without actually having the liability yet. I believe it's the fourth quarter 2020, but there is a reconciliation on the Form 941 to take into account the reductions that you've already received of deposits made and the advance payments. So you're reconciling back to the total tax credit that was available and how it was obtained from the IRS. So again, we talked that the first ERTC was last year effectively. Big thing here is if you received a PPP loan originally, you were not eligible for this credit. Okay, so it was one or the other. And what made you an eligible employer for purposes of the ERTC last year? You had to have partial or full suspension of your operations or a significant decrease in gross receipts, and that was defined as more than 50% quarter over quarter when comparing a given quarter in 2020 to the same quarter in 2019. And employers were eligible for this if they had 100 or fewer full-time employees. So let's fast forward to December of 2020, when we had basically some revisions, if you want to call it ERTC 2.0, you can, but basically revisions that were made to the ERTC as a result of the Consolidated Appropriations Act. So what changed here? What are the mechanics of the revised credit? Well, now rather than 50% of wages paid to an employee, it's now 70%, up to 70% is the credit, and it's based on a maximum of 10,000 of wages per employee per quarter. So what does that mean? In the given period in 2021, an employer could obtain a credit of up to $14,000 per employee. That's $7,000 per quarter, because this credit is in force from 1/1/21 through 6/30/21. Okay, so no longer is it 10,000 for the whole year, it's 10,000 per quarter. Group health care costs are now included in the calculation of wages to determine the credit. So that's a big change, and that's retroactive as well. So if you didn't claim the ERTC in 2020, you can go back and claim it now and use the group healthcare costs in your formula. So the biggest change here is that if you got PPP funds, you're now eligible to obtain and receive ERTCs. And this is retroactive to when this was first instituted in March of 2020. So that's a huge change. Eligibility. Now the rules state that you have to have a decline of more than 20% of revenue in a quarter over quarter between 2019 and 2021. So that's a huge change from 50%. And alternatively, you can use a prior quarter to determine your 2021 eligibility. So rather than using first quarter of 21, you could say, okay, I'm going to use fourth quarter of 20, which would be the prior quarter to first quarter of 21, and compare fourth quarter 2020 versus fourth quarter 2019. And employers that can take this tax credit now, they can have, if they're, I guess, a little bit larger, up to 500 full-time employees, businesses will be eligible to take this. And one thing I want to step back and say regarding PPP, there's no double dipping here. So even though you are eligible to get the ERTC and have a PPP loan together, the wages that you're using to determine PPP forgiveness cannot also be used to calculate an ERTC. You can use some of your wages for the forgiveness calculation and some of your wages for the ERTC purpose, but you can't use the same wage for both calculations. So that's an important distinction I forgot to mention a second ago. And last sort of comment here on the ERTC is we're like typical 2020 tax return season. We're waiting for the IRS. There's still guidance on how we're going to get these advance payments. It just sort of goes hand in hand with everything else that we're waiting for the service and the delay of tax season this year. So really not shocking. There was one other tax credit on the sort of overview slide. You know, what else is out there to consider? Definitely employers need to take into account, whether they're eligible for the Family First Coronavirus Response Act credits. And these are credits based on qualified sick leave and wages that were paid. If you were, you had someone who was sick and were taking care of family as a result of the pandemic, there are tax credits that are out there for that. So it's definitely something to consider with your tax advisor. So that was sort of the other credit that needed to be mentioned. So next area we're going to talk about briefly is sort of what President Biden's tax framework, his positions on tax reform or changes that have been announced. So, as would be expected, the first change would be let's talk about individuals, increase the top rate to 39.6%. Currently, the top marginal rate is 37, and this 39.6 rate would apply to folks making more than $400,000. And you'll see a theme here that $400,000 is really Biden's stance on not impacting folks that make below that. He drew the line in the sand and said, well, wealthy taxpayers that can pay more tax are those making more than 400. So we'll see that more here in a bit. Essentially, the capital gain rate that's being proposed for really high income taxpayers is converting capital gain income into ordinary income. And what does that mean? Those who have income over $1 million, if you've got capital gains, his framework is that we're going to increase that rate from 20%, which is the current max rate, not including the net investment income tax, to the top marginal ordinary rate of 39.6. So that's a huge change. A couple other individual provisions. Enhancement of the child tax credit. This is a big deal. I know I have 2 minions at home, so this will be a welcome thing. Basically, currently the child tax credit's $2,000 for those under 17. Biden's proposing, or he's mentioned that his position would be let's do a 1-year increase for this, and for kids 6 to 17 we'll make it $3,000, and for kids under 6 we'll make it $3,600. And a big change here is making it fully refundable. Currently, if you have child tax credits that exceed your total federal tax liability, you don't get the excess back. You can offset so for example, if your child tax credits are $6,000 and your net federal tax liability before those credits is 5, you're not going to get that extra $1,000. It just kind of poof goes away. But with this 1-year increase and enhancement, he's really trying, his thoughts here to make it refundable. Itemized deduction changes. I think most taxpayers can relate to feeling this pain over the last couple of years of, first of all, the state and local tax limitation. If we jump down to the third point of being capped at $10,000 for all of your state and local income tax and your real estate taxes. So thought there is to eliminate that limitation and to cap itemized deductions in two manners. One is to ensure the total benefit of the itemized deductions does not exceed 28% of a tax benefit, and then reinstate the P's limitation. And that's basically as the taxpayer's income rises, the allowable amount of itemized deductions would decrease, something that existed a few years ago. And the thought here is to bring that back into play. So some business tax provisions that President Biden has been vocal about. C corporations, if you're operating as a taxable entity, currently that tax rate's 21%. Before the Tax Cuts and Jobs Act of 2017, it was a graduated rate up to 35%. It's now a flat 21. Biden's proposing a flat 28%. And then I'm not sure how relevant this would be for those on this call, but to reestablish or reinstitute a minimum tax for large corps, and this would be for those that have book income greater than 100 million and have effectively no federal tax liability. There's a flat rate of 15% on book income here. Probably the biggest impact to those on this call will be the pass-through entity changes. I mean, we see most of our dealerships operating in pass-through format, be it S corporation or LLC tax as a partnership. So currently, those tax returns generate a qualified business income deduction to their owners of 20% of qualified business income, which effectively taxes, assuming you've got the individual owners of those dealerships that are in the highest bracket. Those folks are getting taxed at a net 29.6 on that dealership income. So it's the 37% rate. I guess it would be 80% of the 37% rate. So the thought here is, again, getting back to that $400,000 figure, if you've got a taxpayer that's making $400,000 or more, you will be ineligible to get the qualified business income deduction. That's a direct increase in tax to dealerships. And the thought here was to eliminate the QBID concept for certain qualifying industries. The big one was real estate. That was sort of tacked on at the 11th hour when the TCJA was passed in 2017. Surprise of who was leading the charge on that. That's not a political comment. It's just reality. Let's see here. Employment tax increase is a big thing to consider now. Again, the $400,000 figure comes in. Right now, if you're paying employees wages, the Social Security component of 6.2% applies to the first 142,800 of wages, and that's in 2021. So you've got the employer and employee side. So that 12.4% is the total. Once you hit 142,801, you don't owe that anymore. Biden's thoughts were to, once you start earning a salary of 400,000 or more, once on $400,000, you're going to start paying that 12.4% tax again, all the way up. It won't. So basically, there'll be a middle ground where the Social Security tax will not apply, and then once you hit 400,000, it will kick back in. And the last thing I wanted to talk about today are just some of the estate tax positions that the president has mentioned in his tax structure. And the biggest thing here is the decrease in the lifetime exemption. It's currently 11.58 million, which has been indexed for inflation over the last few years. His thought here is to reduce this to 3.5 million. Well, that would be the lowest it's been since 2009. That's the last time it was about 3.5 million. The lifetime exemption was adjusted, a $5 million figure adjusted for inflation between 2010 and 2017. And, you know, this is really going to affect folks when they're trying to do either succession and estate planning, or, you know, someone dies and they have, you know, what's the value of their estate and are they going to be subject to estate tax? So it's a huge decrease. Same thing he's mentioning or proposing, increasing the estate tax rate. So currently the first 11.58 million of estate would be tax-free. Once you get over that 11.58, you would pay 40% tax on the excess. The thought here is, under the new rule, once you hit over 3.5, you'd be taxed to 45%. So an increase of 5% of tax. So huge decrease in the value of assets that would be subject to an estate tax. The sort of the big kicker here too is, you know, under the old rules, heirs, you know, whatever's in that estate, be it small business interests, be it cars, homes, investments, etc., those assets at the date of passing would step up to get a step up in their basis to fair value, based on the date of death of the person whose estate we're referring to. So the heirs get these assets and they have a fair market value basis in that at the time they received it. So if they ultimately sell it, you know, let's say you sell it a year later, there's likely not much gain in that. Well, as part of these contractions in the estate tax rules, Biden's proposing that that basis increase be eliminated. So what does that mean? Not only does the estate have a lower threshold in which to pay tax at a higher rate, then all of a sudden the assets that are transferred to heirs have a carryover basis. So, you know, in my example, you know, let's say I get a home transferred to me that was purchased for $50,000 in 1930. That would be my basis. It wouldn't get stepped up to, let's say, $400,000 if that were the value when the decedent passed. So sounds like a record-keeping nightmare to try to figure out what the basis is, and sort of a 1-2 punch here in unfavorably of an increase in rates and taxability and no fair value step up in basis. So it'll be interesting to see how these things ebb and flow, and when we may get some sort of conclusion on the introduction of legislation and when that process may start. But very interesting stuff right now.
Thank you, Matt. This is Sam McGrasty with Ready Ware Dealership Advisors. I wanted to thank Matt and Brian from our team to present. I know we threw a lot of stuff at you here in the last 30 minutes. So if you do have questions, I know we have some in the queue. We'll respond back to you very quickly on that. We hit a lot of things at a high level. I did want to thank Adam Crowell and the folks over at ComplyNet, great strategic partners of ours. And thank you for sponsoring this webinar with us. And again, if you have any questions, please email them over to us. We'll respond back, and we look forward to seeing everyone next month on our next webinar. Thank you.